So we are producer-owned, we are a cooperative, but just for grounding for everybody in the room, and I'm going to give you two choices, and this is audience participation. I want to show of hands. As a cooperative that's owned by its members, member cooperatives and farmers, is it A, more important for us to serve our members, or is it B, more important for us to make money? So there are two choices. Okay, so those that think it's most important to serve our members, please raise your hand. Okay, those that think it's most important to make money, raise your hand. Okay, good. It's a trick question. The answer is both. If we don't make money, we can't serve our members because we go away. And the whole notion of what we do for a living is we're a very asset-intensive company because individual cooperatives can't own a petroleum refinery, can't own a grain terminal, but collectively they can through CHS, the company that they own. So we are the nation's leading producer-owned cooperative. We're Fortune 69 out of the Fortune 100 right now, about $40 billion in revenue last year and about $1.25 billion in earnings within the business. But if you think about just simply, how we think about the business, you think about an acre of land or a hectare as a production plant, okay? We should be able to supply the operators of that plant everything it takes to produce the product and to be able to market that product for them at the end of the day, either directly in the form of a commodity or increasingly by adding value to it. Okay? And then we can link them to the profit stream, both upstream and downstream, as well to allow them to economically participate. Cooperatives are different around the world, but within the U.S., there's three things that would set us apart from a publicly traded company. Number one is our governance. Okay? We have 17 directors. They're all democratically elected to terms of 3 years to represent a group of owners in a specific geography. Number two, balance sheet management is different than a publicly traded company. The majority of the equity we operate on is earned equity of our owners. We use that for a portion of time, and then we'll retire or redeem it back to them over time as well. And the third thing is, and probably the biggest difference for us, is taxation. We are able to pass the earnings back to our owners that are associated with their business transactions with us, tax-free from us to them. They pay their income tax on, but it's single taxation. We call it pass-through taxation. We're a publicly traded company. We pay tax on our earnings. We would give dividends to our owners, and then our owners would then turn around and pay taxes on those dividends again. So it's a unique business model that has some tax preference to us, but that's what allows us to make investments on behalf of our owners. Very diverse business. You're not going to find probably another Fortune 100 company that both make salad dressing and operates petroleum refineries. Okay? It's a fairly novel business mix, and it's our ownership model that allows us to do that. Because of their economic participation. If we were a publicly traded company, there'd be no tolerance for the portfolio that we have. We have 14 different P&Ls within the company. We are a global company. We have employees in about 24 countries around the world. We do business in about 65 countries around the world. And you would say, well, as an American-based cooperative, why would you do that? And the simple way we think about the business, we heard the word relevance today, and Hugh Grant's talk. We talk about that a lot, and we'll do more. But everything we do is for one of two reasons. It either creates more direct value to our owners through patronage linkage, that dividend flow that I talked about, or it indirectly benefits our owners by becoming more relevant to our customers. Okay? We are a large exporter of grain out of the United States, and in order to be seen as a Tier 1 supplier globally, we have to be able to originate grain 365 days out of the year. And that's why increasingly we have a presence in Brazil, Argentina, the Black Sea region, Canada, Korea, throughout Asia. And that's what it takes for us to be seen to be able to deliver that value on behalf of our owners. 10,000 employees worldwide. So a little bit on our ownership structure. In CHS in its current form, legacy co-ops have been around for about 80 years, but it was formed in 1998 through the merger of two co-ops. Harvest States, which was a centrally owned grain cooperative, and again, simple notion, individual producers on any given day couldn't market grain effectively against a multinational. Collectively, they could. And on the federated side, the co-op ownership side, likewise, individual co-ops couldn't own refineries, collectively 1,100 of them could. And that's what formed the ownership structure that we have today. So we are literally a hybrid cooperative with both central and federated ownership. On the individual side, about 75,000 individual producers hold equity today in CHS. When they get their patronage or dividend checks every year, we pay them 35% of that in cash, 35 cents. 65% of that is in the form of equity certificates. Today, when they retire at age 70, they get a check for all their accumulated equity in CHS, and we're now to the point where we're writing $1 million equity checks to producers when they retire at age 70. So think about it. Tax-free distribution at age 70 by doing business with a company you own. And the benefit to them is, or the reason why, is we operated on that capital and grew the business over that period of time. We have 1,100 locally owned cooperatives today that also own stock in CHS. They would represent about 70% of the voting stock in CHS, and of course individual patrons would represent about 30%. And we also have about 10,000 preferred stockholders. We have preferred stock that trades on the NASDAQ, $25 par value, 8% coupon. There are no voting rights associated with it. Okay, so it looks a lot more like debt than it does equity because we pay the coupon on it. But it's just another source of a way to bring capital into the cooperative. We have about $319 million of that outstanding and have issued into it quite a while. So structure, if you look down the right-hand side, those are all individual operating P&Ls within the CHS. Wholly owned business. We have a transportation business that owns our petroleum, finance farmers, we'll hedge the crop, we'll insure the crop. We're the largest marketer of sunflowers in the world. We have a feed division. Country operations is 400 local cooperative retail locations that are part of CHS on our balance sheet. Processing. Increasingly in the soy space, we've been focused on value-added processing in the specialty space, soy protein concentrates, isolates, isoflavones. We acquired a company about 18 months ago, an Israeli company that's very significant in that space, and is a way to add value to the output of our owners. Crop nutrients, the largest wholesaler of crop nutrients in the United States, and of course I mentioned our trade marketing position. And in the energy space, we'd be the largest supplier of refined fuels and propane to rural America. But in the world of energy, we are teeny tiny. Importantly, we are, but in the total scheme of the world, we're a pretty small player there. And we have a lot of partnerships, and it's a way for us to manage risk within the business, but also extend the balance sheet. So Ventura Foods is a 50-50 joint venture between CHS and Mitsui Company out of Japan. It's the largest specialty oil supplier to the food service business in the United States. If you buy a Subway Chipotle chicken sandwich, the sauce on that sandwich came from Ventura Foods. Okay, so again, it's a way to create value add. The linkage back to our owners is soybean oil, right? So we can take a bushel of beans that our owners produce, we can crush them in one of our plants into oil, we can sell oil to Ventura. Ventura creates a value add ingredient, sells out to Subway, and that profit stream all the way back to the bushel, we can link back to our producer owners. Temco is a 50-50 joint venture with Cargill. It's our P&W grain export facilities. We have 3 of them that we jointly own together. Both Cargill and CHS will sell grain in, and we'll both sell grain out. And it's just an operating LLC, and it works out really well because it's a way to leverage assets and investments. Art Mills is a new one, and you can see the asterisk. It's pending regulatory approval. That was a 75% Cargill, 25% CHS flour milling venture in the United States. We're bringing ConAgra's flour milling business into that as well. We're accepting dilution to CHS in order to accommodate that, so Cargill and ConAgra can have equal shares. But the important thing is it'll be the most significant flour milling company in the United States. Even though we're accepting dilution, the business is obviously much larger tomorrow than it was yesterday, and we'll be supplying all the wheat on behalf of our owners to that flour milling venture. So again, it's a way to manage the balance sheet, manage risk, but create more value for our owners. McPherson, Kansas refinery, that was owned by us and 2 other cooperatives. We're buying out our cooperative partners right now. We will own 100% of that refinery in 2015, but it's a primary source of obviously refined fuels on behalf of our owners. And then we'll partner, and I'll talk about this a little bit more, with local cooperatives, and we literally have dozens of LLCs that we'll put in place that allows a local co-op that wants to take on a significant project to partner with CHS, offload some of that risk off of their balance sheet to put it onto a bigger balance sheet with us, allows them to accomplish what they want to have with their owners, but not put the enterprise. If you look at, you can see the star, that's in Inver Grove Heights, basically St. Paul, Minnesota. We got started up north, and you can see the concentration illustration of assets that we have up north. But it's almost, if you look at it, like a T. And the reason why is the Burlington Northern Railroad runs east-west up north. Union Pacific Railroad runs north-south down the middle. That's how you move grain. There's a pipeline that runs north-south along the same route, and a pipeline that runs east-west, and that's how you move petroleum. Okay? And that's why we are where we are. So that's how we basically built the business over time. So I'm in my third year in the company. Our fiscal year is August 31st, and so getting close to coming up on that. And I would have liked to be able to told you I've been to every one of the facilities we have, but the guys keep buying them faster than I can visit them. So I'm not keeping up quite. But if you look at the kind of travel flow, you can see a lot of work in Asia. Asia is our largest destination market for grain. And if you think about what you heard today from both Sonny and Hugh, it's absolutely true. I mean, the appetite for grain in the world is going to do nothing but continue to grow. Just to give you a little bit of perspective in terms of how big that appetite is, about a year ago, one of the Chinese grain purchasing entities tendered for 85 cargoes of soybeans in one tender. Okay? One cargo is 75,000 metric tons. Average U.S. yields are about 1 metric ton per acre. Okay? 75,000 acres times 85 in one tender. Okay? And that's just China. You know, we're not talking about Indonesia, Myanmar, Malaysia, Vietnam. You know, economic wealth is starting to spread throughout that region, and they've got the money to buy grains because they want to eat protein, and so there'll be more mouths to feed, but people want dietary upgrades, and we absolutely see that to be true. We're absolutely convinced of it. Customers in Latin America, I mentioned some of the assets we're putting in place in Brazil and Argentina to be a tier 1 year-round supplier. And you can see a lot of travel over to the Eastern Bloc in Israel, and that's where we built out our footprint in the Black Sea and soy protein facilities in Israel. In fact, I was there last week visiting them. But and then South Africa was actually interesting. You know, we heard about Tanzania. You know, think about Zambia, Republic of South Africa. We went there a year ago to assess what we thought the business opportunities might be. We spent a lot of time within the region. And our conclusion at this point in time is there's just so many fundamentals that need to be addressed there. You know, from infrastructure, rule of law, land purchase rights, that we think it's going to be a while before that market will emerge. Productive capability, no doubt, no doubt. It could be the future breadbasket of the world, along with Eastern Europe, but they suffer from some of the same issues. Just rule of law is just so problematic in some of these places. It's just not very good from a foreign investment attraction standpoint. Additionally, you know, and this would be a good point. You know, one of the benefits that I have for cooperative ownership is my owners are my customers, right? And there's two ways you run a business or a company. You either do it inside out or outside in. Okay? Inside out is you make stuff and you figure out who you're going to sell it to. Outside in is you understand what your customers, in our case our owners, need, and then get them what it takes for them to want to do more business with the company that they own. And so that's what we're very, very focused on from an outside-in standpoint. Just got back yesterday. I'll be heading up here from here up to the Pacific Northwest to visit some more of our owners tomorrow. But from last September till about today, I visited with about 50 of our local cooperative owners, along with their boards of directors in their boardrooms. And you learn a lot in a hurry when you can sit down and have that kind of conversation with your owners. And people say that takes a lot of time, and it does. But you know, I used to work for a publicly traded company, and I spent a lot of time on Wall Street with investors. It's no different than what I do today, except my investors are in North Dakota, South Dakota, Minnesota. They're not in Manhattan. And so, you know, it's just a commitment to your owners, and I just think it's a real good discipline in terms of how you run a business. So, you know, if you think about it again, our primary job is to be relevant to our owners, is to do things for them they can't do for themselves, right? As a regional cooperative, that's our job. And so we need to understand, as they look at the world, what does it take to be competitive so that they can continue to gain market share as well.
We've done a plant partnership at Crestline, Ohio, as well as Kenton, Ohio. We're trying to increase our efficiencies for all retailers.
He understands too, when you see the facility like Crestline, the amount of money we've invested there, that we're doing this for his betterment.
The biggest thing is just having that stability, knowing that if your cooperative is strong, you know that company is going to be around to have the product for you.
We have to adapt to these changes. We have to keep up on technology. We got to rely on CHS to source all the products worldwide that are the best for us to sell to the farmer to help him produce more.
We appreciate the ability to get a good quality product in a timely fashion, and they've been helping us get it at a reasonable price too.
So this is a great example of sharing investment jointly between CHS and one of our local owners. Because one of the challenges the cooperative system has is we need to recapitalize the infrastructure that we've got out there. A lot of it is starting to get pretty old. Now, the good news about cooperatives is they're fiercely independent. The bad news about cooperatives is they're fiercely independent. And so left to our own devices, what we would do is put two subscale assets right next door to each other because we can, right? And so here's a great case where we were able to talk to George Secor at the co-op and say, hey, look, we would like to sell crop nutrients to other cooperatives in the area. You have a strong established retail base. Instead of putting up a 10,000 ton plant, a 15,000 ton plant, let's put up one 30,000 ton plant and share it. You can retail out of it. I'll wholesale out of it. It's much, much better scale for basically unloading trains and everything else. And so by partnering together and become interdependent versus independent, we share risk, we put in a more efficient asset base, and we can compete with anybody. And that's a model that we're trying to replicate much more in the countryside. So we just think it makes a lot of sense from an efficiency standpoint. So in the last couple of years, we've begun spending, we've committed about $4 billion in CapEx on behalf of our owners. We've made about 3 dozen significant announcements and acquisitions that we've made, partnerships that we've done, investments, and in that same time period, we've returned more than $1 billion to our owners. And that's kind of the duality, the responsibility we have, is to be able to provide that wealth back to our owners so they can grow their businesses locally, but retain enough of that so we can grow the corporation or the company that they own on behalf of their behalf. We've grown to 10,000 employees, as I mentioned, and I'll talk about a little bit more, but we've really focused on strengthening our alignment with our owners. I think that's critically important because if you cut through everything, you say, what is one competitive advantage that we should have? Okay? When your customers, that's pretty powerful if you leverage it, right? And so we've become very focused on figuring out how we can do that better on behalf of our owners. So just a little bit on the energy platform. About $1.5 billion investment underway right now. Just some refurbishing that we have to do at the Kansas refinery, buying out the rest of the shares of the Kansas refinery, and we'll expand the refinery by about 20%. And so by the time we're done, that will give us about another 45,000 barrels a day of production, which in the grand scheme of things isn't huge. For us it is. But by contrast, our Montana refinery produces 55,000 barrels a day. So the way I think about it is, in a fairly short period of time, we'll have picked up the equivalent of a third refinery on behalf of our owners, and it's a pretty nice business to be in right now if your refineries are situated in the right places, and ours are. We have very advantaged refineries. Domestic and global grain. Talk about Asian grain flow. We are the leading shipper out of the PNW, and we could be content to ship the same amount of bushels for a long, long time and watch our market share erode because demand is growing rather significantly. And so our Temco joint venture will spend about $250 million and nothing else, just to increase the speed at which we can load ships out of the PNW. There's just so much demand out there, and the nature of what our customers are demanding is changing a little bit too. I mean, decreasingly, they want 75,000 cargo of soybeans. They're saying, I want 25,000 tons of wheat, 25,000 tons of beans, and 25,000 tons of corn, and they need to be able to handle that, what we call a grocery load, to basically efficiently deliver that. We don't have to, but then our customers also don't have to ask us to do business either, right? They'll go find somebody who will serve that need for them. Crop nutrients. I mentioned that we are the largest wholesaler of crop nutrients in the U.S. We're looking right now at back integrating into nitrogen production and are halfway through the feasibility study on a $1.5 billion nitrogen plant in North Dakota to take advantage of the inexpensive natural gas up there that's basically trapped in the Bakken region. We'll finish the study. It's interesting. Just to figure out it's a good idea, it's a $10 million bill. To get your engineering costs down to 10%, it's a $25 million bill. And when you go build it, it's a $1.5 billion bill. We would expect by the end of this year we'll know whether or not we're going to do it. We're not seeing anything right now that tells us not to. But from a balance sheet management standpoint, this is a risk that we'll probably offload to a partner as well. We'll obviously have a significant position, and we could go do this on our own, but it would be a quarter of our balance sheet. And we are in a very volatile business. And generally, when you look at cooperatives, when they go bankrupt, it's not because they their assets, were basically bad, they became illiquid. They get in a cash crunch, right? And so we manage the balance sheet very conservatively to ensure that that doesn't happen, and at the same time meet the competing needs of investment and returning capital to our owners as well. Value-added processing, I talked about the soy space. We really like that space. I mentioned strong position in sunflowers, growing position in beans, strong position in wheat. Really the only value-added downstream we don't have a position is corn today. And we just haven't seen anything there yet that we really like that we think could generate superior returns for our owners. Our most expensive capital is our owners, and we treat it that way. And we look for a minimum of 12% return on equity, our owners' equity for a project or what we're doing. So it's a pretty high bar, but again, it's their money that we're operating on. If we can't meet that hurdle, then we should either find another project or return the capital to them. Enterprise value, this is a little bit of work that was done before I came to CHS 3 years ago, and it basically was what is the company's aspirations. And it was growth in the energy business, growth in global commodities, which was grain and crop nutrients. It was a producer focus, it was leveraging the enterprise, it was food processing. And food processing, grain, crop nutrients, and energy, we had to define what that meant to go do. Okay, these are all, sure, nobody's going to disagree, but how do you execute it? Well, we got that part figured out, and that's actually the pretty easy part, because you either go build it or you buy it, right? Producer focus, you don't go down to Best Buy and pull it off the shelf. That's an orientation that we have to take to the marketplace, and that's that outside-in focus that I talk about. And then the other one that's difficult is enterprise value, because we were put together as two separate companies. We have 14 different operating P&Ls within the company, and in many respects we act as a holding company just because of the commodities nature of our business. So there's a real tension there that says, if you let everything purely operate that way, you can miss opportunity. But if you force divisions to work together, you can create inefficiency. Okay? And that's the tension, because our margin structure doesn't permit that. So what we're working on right now is to try and take a look in terms of how we can do it. And it's how we encourage the discovery of opportunities between our business units to work together to create value that otherwise doesn't exist. And give you a hypothetical example, because we just talked about it. We were just in Israel last week at our plant. Israel's a small country, but we have a strong position in a small country, and leading supplier of vegetable oil, soy oil, and soy meal to that local market. Okay. Well, we're also a leading exporter of DDGs, which is a co-product of ethanol. So we put a feed plant in Ashdod, Israel, to supply the local market, because we're basically both sides of it. Those reside in two different divisions of the company. They also sell their own vegetable oil brand for the food service industry. Kind of sounds like Ventura Foods. Does Ventura Foods have some customers in the region? I'm pretty sure I saw KFC in Tel Aviv. Yeah, they do. So is there another opportunity to create linkage between different divisions of the company that wouldn't be intuitive? Because everybody's got a day job, right? And you can get the group together and say, let's brainstorm, and then you send them all back to go do what you pay them to do. You need to have somebody who can actually focus on these intersections where self-interest aligns. You're not creating a winner and a loser, because that's a waste of time. It's how do we work together to create new value for our owners that otherwise wouldn't exist. And so we're starting to spend a lot more time on that. We've got 2 pilots that we're going to kick off here pretty quick in order to do that. So talking about our owners and how important it is for us to be aligned with them. So again, show of hands. If you got up every day, where none of your business came from, would you feel good about that? You like that business model? How about 25%? Does that excite you? 50? Tough group. 75. Who feels okay if you know where 75 business is coming? There's an honest one. Me too. Okay. So, but think about it, right? So that's the importance of alignment, even though you have independent owners. And so what we would look at in the United States is we have 1,100 members today. Numerically, that's going to go to 600 within about a day. Okay? That's nothing CHS is causing. That is a pencil or a ruler and the continuation of a trend. Okay? It's happening. And it's probably slowed down a little bit right now, and the reason why is agriculture is so good right now that that tide is floating all boats. Okay? But within the cooperative system today, we have over 50% of our owners aren't reinvesting in depreciation. Think about it. And depreciation is not a high bar, right? I mean, you tell me anything you're going to replace tomorrow for what you paid for yesterday, right? No way. So we just know that mathematically this is going to happen. And the big challenge, quite frankly, is production agriculture in the United States is producers demand speed. When they're harvesting grain, they want to dump it. And they won't wait in line to dump it. So you better be able to get that done for me, or I'm going to go down the road, or I'll put up my own storage, right? You don't want a $350,000 combine idling in the field waiting for the truck to come back. They just won't tolerate it. And so the demand for capital as farmers continue to grow, one of the biggest challenges for successful co-ops is how do they continue to have that investment for future growth. So our thought is, you know, we favor alignment, and what we think out of that 600 is about 150 of those 600 will be part of our country operations group, okay, where local co-ops have come onto our balance sheet, exchange co-op stock for CHS stock at the individual producer level. Generally, the reason why that happens is their appetite for growth, the need for capital is greater than they can secure locally or from a neighboring co-op, and that's the value that we bring, and that's their choice, right, if it makes sense. We also see that about 300 of those will be locally independently owned cooperatives that may have a preferred relationship with CHS in the form of co-investment, like we saw in the fertilizer plant, where they lay off some risk to us, but they still have the benefit of local ownership. And we would also see about 25% of that being just fiercely independent transaction. And that's their call. They own us, right? And that makes us a better competitor. We have to be, you know, make sure we're in the market every day for all our owners, and so we're okay with that. And those are the three clear choices that we see that we can offer our owners to do business with us. But if you think about it, if you have 25% of them in your country operations and 50% of independent of the line, what's 25% plus 50%? There's my 75, right? That's what we aspire to. Now, just because they're on our balance sheet, you got to go earn the business every day. You know, even though country operations are cooperatives that CHS owns, they're not obligated to sell us a bushel of grain or buy a ton of fertilizer from us. If we're not competitive in that local market every day, they need to go do what they need to go do on behalf of their farmers. Because we will not introduce inefficiencies into the system. And I know that sounds a bit counterintuitive, but it works really well. It keeps us competitively sharp, and in places where we can't meet that need between two divisions, we ask the question why. You know, and it usually comes down to assets in the wrong places. And then the question is, does it make sense to do it or not? But that's a bit of the tension of the dynamic that works for us, given what our business looks like. And we don't want to lose that, but we do want to foster greater opportunities to be put together. So, you know, our thought is, you know, we're going to offer our owners these choices. They're going to make these choices, and the marketplace, not CHS, is going to tell them whether they made the right one, right? And we think that's a pretty transparent way to run the business. Just a couple ones we've recently done. These are about $25 million projects each. These are 110 unit car train shuttle loaders that we did with two local cooperatives. They're going to operate the LLC. They own 50%. We own 50%. We get first look at the grain, but they don't have to sell it to us if our bid's not competitive, which again is a bit unique. And it makes sense for them because, you know, they're linked to a global marketer and us by creating more value for their individual farmers on a local basis. Technology. You know, when I grew up, it was how straight you could plant, right? I mean, that was the mark of a good farmer. Well, today, all you have to do is turn around and you take your hands off and AutoSteer does it for you, right? So these great rows are no longer an indication of successful farming.
They embrace technology. They love technology. They get disappointed if there isn't more technology.
I carry a smartphone with me and have internet access for weather and markets and email information.
They're in the tractor. It's auto steering down the field. They're reading their iPad, their iPod, their cell phone. They're checking the markets 15 times a day.
You need to embrace some of the ways that they speak to each other. So we're doing more things in the social media area so that it's timely and relevant and they can get it when they want it.
The time to get crops planted or harvested seems like it keeps shrinking. So it's very important to have real-time information and have access to people that know how to use it.
We're going to do our soil test, apply all our fertilizer. Now we're starting to implement our yield maps into those fertilizer recommendations.
So Yield Point is our precision ag platform. It's implemented through our country operations system or group. And basically, you know, it's the intersection of a bunch of different technologies, and that was alluded to at lunch today, right? There is no silver bullet. But it's everything from fertility, seeding rates, soil type differences, how you optimize not only the right variety of seed, but the plant population on any specific piece of land. And I do believe, you know, we're probably not going to see a whole lot more silver bullets anytime soon. So it's how we squeeze every incremental bushel off of the existing land that we've got, I think is where the future is going to be. And the technology is advancing pretty rapidly. I farm as well, and on my way over here from the airport today, I checked the moisture level in every one of my fields. Last night I looked at tissue samples that were taken from all of my fields. This morning we customized the fertilizer mix to match the results that we saw from there, and we're spoon feeding that through the irrigation system right now. And by the way, I live in St. Paul, Minnesota, and farm in Portland, Oregon. I mean, it's there, and it's easy. I shouldn't say it's easy. No, technology is a great equalizer, right? It overcomes time and space, and that's just an example, but that's where this thing's going. And fertility management is going to become, I think, one of the next big frontiers. You know, so lots of different partnerships that we've got that we're working with. You know, if you think about what agriculture is becoming, and it's a great time to get back in. Hugh mentioned it. Literally, there was a lost generation, and there were a few of us that grew up on farms, and it just wasn't a good time to get back in agriculture. When I graduated from college, interest rates were 18%, and I already had an older brother farming with my dad, and my dad said, "I love you, but I'm not going to pay 18% interest to go buy my land." And I was one of the dumb ones who wanted to stay in agriculture, so I did. But we've got a huge generational skill. From folks that are in their early 50s down to their early 40s, which means that anybody coming into agriculture today, two things. Number one, they're going to get to see opportunities a lot sooner out of necessity than a lot of other folks did. If you just look at our cooperative system right now, of those 1,100 co-ops we have 300 co-op CEOs eligible for retirement in the next 5 years. Okay, that's just the bubble working its way through, right? And so it's a great time to come in. The other point that I would say too is if you look at demographically where we're going in agriculture, you know, this isn't like, you know, the oil fields in the Bakken in western North Dakota, right, that may have a finite life. This is career. This is decades of growth that we're going to see in agriculture for everybody thinking to come in. You know, so it's not going to get in and get it while it's good and get out. You know, anybody coming out of school right now looking for a career in agriculture is going to have a fantastic run. And it's a different run. It's very, very technologically driven. That's where the big differentiator is going to come from. Last point I would make on this, our biggest competitor for talent is the farmers. Okay? Kids are going home to farm, probably at rates that we've not seen. We've actually losing some tenured employees that are going back home to farm full-time as well. There's a demographic issue. You know, grandpa's deciding that there might be time. A lot of times it's a skip generation. Dad, like me, got out because he wouldn't support it, but dad's son's going back to take the operation over from grandparents. If there's any lament right now is it's not happening fast enough because grandpa's having a lot of fun farming right now because it's really good. He doesn't want to let go of the reins, right? We're seeing that quite a bit as well, but just really, really exciting times. The USDA, in terms of how they calculate, you know, net on-farm employment or operations, they go by decision maker, but if they actually did it in terms of people actively involved in the operation, if they actually defined it that way, I suspect we might see the first increase in on-farm population in the United States since the Civil War. Okay, there's actually a renaissance of folks going back. I should mention that hedging risk management. You know, that's probably one of the biggest differentiators that farmers see. You know, they would say that, you know, as technology is advanced, that's a great equalizer, right? So you know, the odds that I'm going to grow 20% more bushels than my neighbor is a great differentiator. And by the way, we compete for land, right? So it's very important to have a competitive advantage. My advantage now is marketing. okay, and risk management. That's because I'm going to be smarter than my neighbor, and that's how I'm going to do it. So we actually have a consulting service that helps farmers put together their grain marketing plans. We can hedge those contracts for them as well as a risk management tool. But increasingly, it's just what one person told me on an airplane one time, you can make a lot more money from your shoulders up than from your shoulders down. Okay? And that's where agriculture is going now as well. Okay? It's about intelligence and the application of technology. Next generation. We don't have to bring this talent back into the system. We have to prepare it to lead this system over the long term. And so one of the things that we've done is we've created a new leader forum, a selected group of young producers that we believe have both the ability and the inclination to become leaders within the cooperative system, not just within CHS and their local cooperatives as well, but to take a look at what are the issues facing cooperatives, rural America, leadership development. One of the things that I'm increasingly hearing, and I'm hearing it, but I don't know I believe it to be true, is that the next generation of youth doesn't value cooperatives the same as their parents do. Okay? Now, the rationale for that would be Grandpa probably helped found the co-op. You may not even know who Grandpa was now. Another one is, instant satisfaction, gratification. I want it now. I don't want to wait down the road to get my economic participation. Give me less, but give it to me now. And then the third is, quite frankly, when farm economics are so good right now, economic participation may not be as important today as it was yesterday. Okay? Those are all the arguments for why it is different. I think the arguments for why it's the same is, I believe, it's generational. I think every generation that comes through has to be re-educated on the value of cooperative ownership. And it's not just about direct economic participation. It's about local control over assets. It's about community development growth. Many communities in the United States, the co-op isn't, right? So there's a sense of broader pride and ownership that I think goes along with this. And so I think cultivating that, at the end of the day, it has to be run efficiently as a business, but cultivating that sense of higher purpose, I think, is really important for local cooperatives as well. Another one that we've created is the CHS Center for Cooperative Growth. It's a virtual center that we created. What we'll do is we'll tap into the leading board directors, academics within the space, and on timely issues around governance, equity management within the co-op system. How do you manage that tension between returning capital to your owners and investing for future growth? What's considered to be best practice? And we rotate basically the issues that we take a look at from a topical standpoint, and we encourage participation. So it's another source for cooperative leadership to understand what's going on, what best practices are, and have some dialogue so we can continue that collective growth of intellectual capital within the cooperative system. Number one thing that we hear, and again, one of the big benefits that we have with cooperative is the word trusted advice. Okay? If I'm raising a crop, it's very, very important to me when you come on my farm and you're asking me to do X, Y, Z, or suggesting X, Y, Z, I have no doubt in my mind that my personal benefit is your highest priority. Okay? If you have to ask the question, why am I hearing this? How much money are you going to make on this transaction? Where did this come from? Okay? That fractures that trust. And many of our employees, most of our employees that work in the country, grew up in those communities. They go to church with these people. Person they're calling on probably watching them play ball as a kid, right? So, knowing that you want to stay in that community, pretty much means that you're going to do the right thing all the time, and that's no. Agriculture is such a small space. You can never outrun your reputation in agriculture. You just can't. It's just too small a market. It's funny, as I sit there at lunch today and listening to Sonny and listening to you, I've collectively probably known those guys for 40 years. It's just such a small world within agriculture. And so that's a big thing that we leverage within our space.
We've always worked with the co-op, seem to get along really well with the guys out there. It's the personal relationships that we've kind of built our trust in them.
I've had a good experience with the co-op. They've always been there for me. Good product, good service.
I did all my financing and stuff through CHS and CHS Capital, which We made it very easy, I guess, to actually get an operating loan to start farming.
I'm always impressed with the kind people that we have at our local co-op.
People that we can trust and pay attention to details and care about the farming operation like they owned it.
So within our employee base, again, continued development for the future leaders within CHS. We have the same demographic issues as everybody in agriculture right now. It's kind of a bimodal distribution. But it's also interesting because one of the things I've done since I've been there is I'll probably have, I don't know, half a dozen coffee sessions with about 8 to 10 employees every month. And so at the end of this year, I'll met with all 1,000. Don't ask me all their names, okay? But all 1,000 of our employees at headquarters. And what's interesting since I've been there, the number of newly tenured employees is growing rather dramatically. So, we are bringing new talent into the organization to help fuel and sustain the growth, and more importantly, create the next generation of leadership that we have within CHS. We have CHS University in the U.S. partnered with University of Minnesota, CHS Agro University in Brazil for our Brazilian employees down there. And it's interesting, they do it at night on their own time and money, and it's oversubscribed.
Hi, my name is Carla.
Our employees
from Brazil.
so really want to learn about agriculture in the company, and it tends to be a very young employee base, that they're willing to commit a huge amount of their own time to basically participate. In Geneva, Switzerland, it's a great training program. Homegrown talent. We're very fortunate, like many companies in agriculture right now, we're growing rapidly. Okay, but it's stressing our system, it's stressing infrastructure, but it's also stressing talent as well. I think the number is actually about 125 interns that we have hired for this year. Again, when you have a company as diverse as ours, I mean, they're in everything from an ag econ finance intern who's working on strategy projects for us, to interns, agronomy interns in the country. We've got 50 locations throughout the U.S., both 2- and 4-year students. We have obviously a strong need for degree program, but if you think about what it takes to operate application equipment, for example, in the country today, or a blending facility, or a grain elevator, this is not unskilled labor. And so there's a niche there for those that don't want to pursue a 4-year degree, that may want to pursue a 2-year technical degree. You can still make a very nice living in the country, be part of a community, and still have opportunities for growth. And so it provides another need for talent that we have locally as well. Majority are obviously in the agronomy areas, but again, accounting, grain merchandising, rail logistics, credit, internal operations, hedging, energy, literally anything that people would have an interest in the ag and energy space. We have opportunities for them to obtain that kind of growth, and that's basically what's building our talent pipeline internally for the future. So, we've partnered with quite a few universities, but we have 22 that we partner with. Leadership events to recruit interns and trainees. Since CHS is a relatively new company, people more recognize our brands than the company. And so educating, potential employees as to who we are, the breadth of the opportunities that can occur within the company over time, is something that we've increasingly spent a fair bit of time with. And obviously, youth agriculture organizations, FFA, AFA, 4-H, active participants and sponsors in there to foster youth development in agriculture. Also offer scholarships basically to ag students as well. So getting our brand in the country, making those connections, basically developing that pipeline. Many of these will ultimately become trainees or interns that we bring into the company as well. So, so what do we formally do? You can see a 2-phase program that we implement, and it's a 2-year program with both educational and hands-on operational experiences, which is important because the available pool of talent that's going to come from a farm is going to continue to shrink, right? Mathematically. So we need to be able to broaden that pool and kind of push the edges for people that have an interest in agriculture in the desire to learn, but maybe don't come directly from that type of a background. In a summer job with a retail unit, you get a scholarship. Participate in the New Leader Forum as well. It follows with an internship, and you can apply for a CHS Foundation scholarship as well. So it's a really nice package for those that are interested in agriculture to get exposed to agriculture first and CHS as well. and another $4,000 in tuition assistance to basically come to work for CHS. And the other thing I would say is our attrition rate is actually quite low within the company. And a big part of it is because our employees are so connected to the country. They either came from a farm, they know somebody that farms, they have a passion for farming, serving our owners. It's a different culture. I had it explained to me yesterday by one of our relatively new employees. She said this place feels like a family. And our challenge as we continue to grow, when you have 10,000 employees today, development programs there as well. We have an Ag Associate program, again, that gives hands-on experience. There's lots and lots of opportunities to gain experience within the ag space and to pursue a career with CHS. New program we've implemented is the CHS Future 40 program for emerging leaders within the cooperative space. We're finishing up our first class right now. I want to say we have about 3 dozen in the inaugural class. But it's a lot of case study work. They'll actually take a trip to Argentina when we're done. But it's some CHS employees, it's leadership of local cooperatives as well. And when you're in Bisbee, North Dakota, 15 miles from the Canadian border, in a town of about 300, it gets pretty lonely at the outpost, right? So to know there's somebody else who's dealing with the same issues you're dealing with every day, it's got exactly the same problems and challenges, everything from living in a small community, having a locally elected cooperative board, challenge to go along with that, to be able to build that network, and be able to talk to somebody in Minnesota, Kansas, Nebraska, who's dealing with the same things you are, that's priceless for these folks, because it gives them a sense of community and growth, and it allows them to bounce things off from others in a non-threatening and sharing manner. So, it's development of human capital that's going to directly go to work for CHS, but also within our cooperative system, because if our owners aren't successful, we can't be, right? So we have to build their bench for them to move on. Sharing success.
The way I perceive a cooperative, it gives us some stability, and by having a cooperative hand in hand with us, makes business decisions much easier for us. The biggest thing is just having that stability, knowing that if your cooperative is strong, you know that company is going to be around to have the product for you.
From the long haul, that's a great partnership where they kind of are guaranteeing you your dividend back.
The cooperative is able to give you a dividend check. That's good to see.
So last year, we sent $600 million to the country, and again, in many of the communities that this goes to, it's a big deal. And quite frankly, it's one of the things that I enjoy the most working for CHS is, when you work for a large Fortune 500 publicly traded company, those dividend checks go out the door, and you have no idea what impact they're going to have at the end of the day. When you see what $7 million does in the local community, great satisfaction that goes along with that, knowing that that money is making a real difference to that local community. There's actually some billboards that Southwest Grain is one of our country operations locations. This is Minot, North Dakota, but $8 million in that community through that co-op. And I asked them how it went, and they said the biggest challenge they had is people didn't believe it. There's no way you can send that kind of money back to the country. But think about it, that's the size of the town. But this is a big impact in these communities. So, I talked about relevance. To me, it's pretty simple. If you're focused on your owners and you ask yourself, or ask them, first of all, tell me what your plans for growth are, how can I help you achieve them, and how can I earn more of your business, right? Those are the 3 questions we ask our owners every time we sit down. And then what we need to understand is what do we need to do to be more relevant to our owners such that they want to share or to do more business with us. Generally revolves around assets, again, because of who we are, but it's about relevance. And, nobody ever calls you up and tells you you're fired, right? They just quit calling, right? So making sure that we continue to have that emphasis to figure out what our owners' needs, what we need to do to help them be successful, allows us to be relevant. mess that model up. I shouldn't say that, I should make it sound really, really hard and complicated. But I actually think if you stay focused, it's not that tough. So I'm going to stop there. You know, as you can tell, I mean, we're very, very focused on talent management. I'm sorry. I think we're right on the end time. But if there's any questions anybody would like to ask, I'd be more willing to entertain them. Thank you, everybody. Appreciate the time.
I've been fine.